All right, hi everybody, welcome back to the channel, and today we're talking about VIG, and this is the Vanguard Dividend Appreciation ETF. I have actually not discussed this one on the channel, but I did write an entire guide on it. It'll be in the description, and we're going to talk about this guide that I wrote today, going over this ETF, and this is one of those ETFs, guys, that if you're looking for one that actually has the potential, because a lot of these ETFs, they don't focus on capital appreciation as much as an ETF like VIG does. And this is evident right here. You'll see that over the last several years, since 2006 when this ETF actually came out, and even over the last 5 years. And this was taken probably a couple weeks ago, but this ETF has generated returns of over 250% when I took this. I think this was posted in April 25th, so not even a week ago I actually posted this. But with that being said, you'll see the chart has been, kind of downtrending recently. In fact, when I took this picture, and that's actually live right there, it's 174. So these pictures down here are a little bit higher at 176. But nonetheless, I mean, this is an ETF that if you're looking for something to consistently grow dividends over time, on top of produce capital appreciation, this is something to really consider. Now, let's go back to the beginning, and we'll talk about exactly what this ETF is all about. So the first thing is, how is this relevant to you as an investor? And what is the purpose of this article? So why are we discussing this ETF? Well, I believe that an ETF like VIG can produce a diversified investment portfolio that is beneficial for you in the long run. We always hear people talk about different asset classes, and we hear about people talking about real estate, stocks, but let's talk about a broad portfolio based upon your investment goals. That's what's important. You can have gold and silver, you can have real estate, you can have stocks, you can have everything in your portfolio as long as you're diversified. And if you're looking at a diversified portfolio such as VIG, you're looking at growth and income over the long term. That's one point that I highlighted with this ETF, is that you're looking at companies that have the potential for corporate health, long-term growth, and health of the company, and resilience. So the resilience factor is very important in terms of potentially serving you as an investor long term, because if you're looking at companies, for example, that are not as focused on the long-term dividend growth and are not as focused on growing the share price and benefiting shareholders in the long term, then you really have a company that might be on the decline, right? So we want strong companies that are going to focus on those factors. And one of the things to consider here is that this ETF has been around since 2006. As I was showing you on the chart, you'll see that the inception is all the way back to 2006. But just so you know, the index that it tracks, moving on to that, the NASDAQ US Dividend Achievers Select Index. Now, this is focused on not only companies that pay dividends, but also have a history of increasing them annually for at least 10 consecutive years. Okay, so basically what you're looking at is an index that consists of record dividend growth, or a record, I should say, like a record of consistent dividend growth. And the reason this is so important, like I said, is because we're focused on long-term value creation to shareholders. We're not just focused on the high dividend yield initially. Now, there's a lot of great ETFs out there, and I've talked about them on the channel. JEPQ is a fantastic exchange-traded fund. But if we're looking at long-term growth in terms of not only the share price, but also companies that will increase those dividends over the long term and give you additional income, we're looking at an ETF like VIG, okay? Because you're going to get the best of both worlds. You can have your cake and eat it too if you're willing to sacrifice that initial dividend yield. Because that initial dividend yield is so tempting, right? When we look at an ETF like JEPQ, for example, and I've talked about this ETF a lot on the channel. I love this ETF, but are we going to see the most capital appreciation in the long term? Look at QYLD, for example. And I'm not trying to compare the specific strategies because they're different in terms of QYLD versus JEPQ. But at the same time, look at the decay. And so I had a subscriber mention this for QYLD, right? You get that initial dividend yield. You get that large initial yield. In fact, I would bet this is paying over 10% right now. Let's see here. So 11.88%. But at the same time, what are you sacrificing in the long term? You're sacrificing the potential for that consistent capital growth. And so what we're looking at here is basically an ETF where if we look at some of these companies, such as Microsoft, Apple, Broadcom, JP Morgan Chase, ExxonMobil, you have some of the largest companies in the world, MasterCard, Home Depot. I mean, come on, Home Depots are all around my area. They're always growing. We have Lowe's as well. Now, I think Lowe's is kind of on the decline, honestly, compared to Home Depot, in my personal opinion. I just think both companies are great, but I see Home Depot taking a more dominant stance, at least in my area. Procter & Gamble, I mean, another company where we use all their household goods on a regular basis, but we often don't even realize it. Just like we use Microsoft and Apple products on a regular basis, computers, smartphones. Of course, Android is another consideration. You know, we have Broadcom, all of these oil companies, ExxonMobil, United Health Group, lots of companies contract with United Healthcare for their coverage and employees and employers. So there's a lot that goes on there. But we have the potential for compounding returns. We have the potential for reinvested dividends, not only to purchase more shares through a dividend reinvestment program, but additionally, the compounding factor results in that producing its own dividends over the long term. So you're getting the best of both worlds once again. You're getting dividends that continually go up over time through that reinvesting. Now, if you choose to actually take the dividends, you can do that as well in retirement. And you can also potentially combine options with this ETF, such as cash secured puts. I had another subscriber for the SCHD, or the Schwab US Dividend Equity ETF. They were doing that on that ETF, so that's a great way to go about doing that. But with that being said, you know, regularly investing in these dividend stocks can help offset inflation, especially if you're getting those increasing dividends over the long term. Now, speaking of that, I know I've mentioned that in this ETF. Let's actually talk about it. What do the dividends look like over the long term? We have a low dividend yield right now. It'll say 1.74% when we get to this page. But let's go ahead and take a look at the actual dividends. All right, 1.76%. Annual dividend of over $3 per share. Once again, the current share price is $174, so that's the current yield right now, less than 2%. So that's going to be less than the federal funds rate. With that being said, though, let's take a look here. 0.7692 for a dividend. If we go back all the way to 1995, and this is where it gets interesting, you have dividends of 6 cents per share. Now, obviously, you have to consider inflation. You have to consider the other factors as well. Everything going on with this is that the dividends were lower, but the companies grew faster in a lot of cases. And I would argue that since 1995, you have a dividend from 0.07 to 76 cents per share. That's about 1,000% increase. I don't think we've seen 1,000% inflation. Maybe in some real estate markets, right? Or maybe in some commodities, or, just saying, like, yeah, asset prices have obviously gone up a lot since then. So we've seen consumer inflation, though, like food, probably not. Probably not 1,000% within that time frame. I would just say, in terms of this ETF, you're definitely going to be keeping up with a regular basket of goods over the long term, just based upon the history. Now, past performance is not necessarily indicative of future success, and I always try to mention that because it's so important. But at the same time, it's so exciting to think about how you could get regular income on a quarterly basis. This ETF pays every 3 months. You'll see those regular distributions. The last payment was on March 27th, 2024. But you get those regular distributions, and it's so exciting to think about how this can be a regular part of your strategy, especially if you're in retirement, for example, or you're looking for income to supplement something in your life. If you want to start taking those distributions, or let's say you have a Roth IRA and you want to start reinvesting those dividends on a continual basis to compound those over the long term. Whatever your investment goals are, this ETF could potentially be something to consider. So, with that being said, just to recap everything I mentioned, we have a fairly low dividend yield of 1.76%, but we also have an annual dividend of over $3 per share, and the share price is $174. So that, takes care of that dividend yield. You just divide the price, $3, or I'm sorry, $3 by 174, and you get that dividend yield of 1.76%. So with that being said, they currently offer a yield of 1.6 to 2%. So you're basically trading off that initial yield for the growth, and you have a moderate yield but higher potential future gains, as we've just gone over. The dividend growth and the share price growth, I would say, well makes up for it with this ETF. The Vanguard Dividend Appreciation Fund, over the last 15 years, for example, if you just held on to this ETF and, let's say, reinvested those dividends, you would be pretty well off right now. And I would say if you compounded that with a calculator, I could do that perhaps in another video, but just going over the exact returns and seeing how much you would have made with a specific dollar amount, and let's say you reinvested every single dividend you received, you're probably talking a significant amount. And so that just shows you the potential. Even over the last 5 years, with those dividends paid out, we're still up over 56% on this ETF. So hope you guys enjoyed the video. And one more point I want to mention. I've mentioned this in other videos, but as I was writing this, the beta was 0.85, indicating that it's less volatile than the S&P 500. So if we go over to finviz.com, this is a great resource for checking out ETFs and stocks and stuff like this. But if we go over here, we can actually type in the ETF, and you'll see it's come back down just from the previous highs of almost $180 per share. But coming down here, you'll see the current beta is still 0.85. That basically indicates that relative to the S&P 500, we are less volatile, and therefore it's going to be one of those deals where this is going to be a great long-term option, especially for you investors who don't like a lot of risk. If you don't want something that's tech-heavy, that you can lose 90% of your portfolio, we saw that in 2022. We saw what happened to growth stocks after the 2021 bull market. You guys all remember COVID. Everybody was retiring. Everybody was getting rich. Now it's a much different market. Okay, so we have to keep that in mind. And the fact is, the beta is less than 1 on this ETF. So the volatility is less, and those consistent cash flows are always something to consider. So hope you guys enjoyed this video. Hope you guys have a great rest of your week. Thank you guys so much for tuning in. If I do have a break for making videos, by the way, my wife is giving birth in the hospital here soon with our 3rd child, so I'll probably have to take a break, and this might be the last video for a while, but I sincerely appreciate everybody who tunes into this channel. It's just a run-of-the-mill channel. I'm just a guy here trying to potentially retire on some of these ETFs and build my portfolio. And so, Lord willing, I'll be able to do that. But once again, guys, thanks so much for tuning in, and I really appreciate you guys watching this, and take care. Hope you guys have a great rest of your week, and I'll see you in the next video.